Oh, hello there, and welcome back to Thanks for That. Today I'm going to talk about the most asked question that I get. What's the difference between a Tfsa and an Rrsp, and which one should I be using? And for those that don't know what those are, they are registered savings and retirement accounts within Canada. In the US, you've got IRAs and Roth IRAs, and in the UK, you've got ISAs, which can hold stocks or savings. Now remember, I put a lot of time and effort into creating this content for you to get for free, so if you could take just 1 second to hit that like button and subscribe, I would really appreciate it. No matter what country you live in, you should be taking full advantage of the tax-free savings accounts. Any gains you make on your investments or any interest earned in savings within those accounts is completely tax-free. The answer to which one you should be using if you can only afford to use one really depends on your unique situation. These accounts do have a maximum that you can contribute within each year, so you don't want to over-contribute or you will be taxed and penalized. Make sure you figure out within your country what the maximum contribution room is. And don't forget that the Canadian deadline to contribute to your Rrsp to save money on last year's taxes is March 2nd. If you do have contribution room left within these tax-free accounts and you don't use it, you're paying taxes on anything outside of the accounts that you gain, whether it's capital gains on stocks or interest within your savings accounts. When it comes to paying taxes on any gains, interest is actually taxed the most. So even if you just have a savings account that made you $200 last year, you're going to end up paying tax on that $200 in interest. But if you held it within your Rrsp or Tfsa, it would be completely tax-free. There's only 2 reasons you should ever have any investments outside of your tax-free accounts, and that is, number 1, if the accounts are both maxed out and you don't have any more contribution room, or number 2, if you want to do some trading within those accounts. In Canada, you're not allowed to actually do day trading in your Tfsa or Rrsp, but you can make a few trades here and there each month. They really don't have a set number of trades that you're allowed to make every week or every month, but they do suggest that you use it as a long-term investing portfolio instead of day trading. It really is just a gray area here in Canada, and if they do decide to deem you as a day trader, they will tax all of your gains as income. So for me personally, I try to stay around 4 or 5 trades within my tax-free accounts each month. The only downside to holding these investments within your tax-free accounts is that if your investments do go down during that year, you don't get to use those losses as a tax advantage either. But let's just hope our investments keep going up. Now let's dive into the differences between the Tfsa and the Rrsp. The Rrsp basically defers your income tax so you don't have to pay it now, but of course the caveat is that you have to pay it down the line when you withdraw that money because it's like income. So no matter what, you are going to pay income tax on your money. You just have to decide if you want to pay it now or later. How do I make that decision, you might be asking? Well, I can tell you. Most people are in a lower tax bracket when they're younger and a higher tax bracket when they're older. The reason I say most people is because there are some professional athletes, like an NHL player for example, that's probably making the most money that they're ever going to make in their 20s. So they're in a much higher tax bracket now than they will be in their 40s. And of course, being in a higher tax bracket now versus later means that you're going to pay more tax dollars now. So you'd want to take advantage of your Rrsp now and max it out as best you can. But for most people, in our 20s, we usually make less than we make in our 40s and 50s. So what I would do is max out my Tfsa in my 20s and 30s, and if I have extra income, then I could contribute to my Rrsp after my Tfsa is maxed out. That way, when I get into my 50s and I'm probably going to be making more than I am now, so I'll be in a higher tax bracket, I can use all that Rrsp room that I didn't use in my 20s and 30s and really take advantage of the tax savings in my 50s. So the Rrsp saves you from paying your income tax now, and when you withdraw from your Rrsp when you retire, that money is treated like income. The difference is the Tfsa saves you no money in taxes now, but when you withdraw in your retirement or any time, the money is treated like cash and not like income. It's not taxed at all. So if you happen to invest in Tfsa in 2020 within your tax-free savings or retirement account, those massive gains that you made are tax-free. And if your investment in Tfsa was not in a registered tax-free account, you'd likely have a pretty big tax bill to pay this spring. For those of you that don't know, the tax brackets work on an incremental system. Every country is different, so I'll just pull some numbers out of the air. Let's just say your first $20,000 is tax-free. Your next $20,000, you pay a 12% tax. Your next $20,000, you pay 15% tax. Next $20,000, you pay 20% tax, and your next $20,000, you pay 25% tax. And then let's say anything over $100,000 that you make, you're paying 35% tax on it. So let's just say you make $50,000 now, and you plan on making $150,000 in your 50s. So if you put money in your RRSP when you're making $50,000, then you're going to save 15% of every dollar that you put into your RRSP. But in your 50s, when you're making $150,000, you're going to save 35% of every dollar that you put into your RRSP. So that's when you can start to see the difference between using your RRSP now when you're in a lower tax bracket or saving that contribution room for when you're older and in a higher tax bracket. I know this is pretty hard to comprehend, and usually when I'm explaining it to people, there's a little bit of back and forth and quick questions and quick answers. So if you do have any questions, just scroll down to the comments down below and put any questions you have down there, and I'll do my best to answer them. I'll give you an example about myself. I've barely used any of my RRSP contribution room. For example, this year you get to add another $6,000 into your TFSA. Now myself, for an example, I've hardly contributed to my RRSP at all, which is going to be very advantageous this year because I'm planning on buying a house, so I'm going to sell a bunch of investments and realize my gains. Now, some of these investments are not held within a tax-free savings account, which means I'm going to have to pay capital gains on those. Let's just use some easy numbers in this example. Let's say I sell $100,000 worth of gains in my investments. Now, the way the capital gains tax works is that you take 50% of your realized investment gains, and you add that to your income and pay your marginal tax rate on that. So if I sell $100,000, I take $50,000 of that and add it to my income. Now let's say I make $50,000 annually as a salary, and that puts me in a 20% tax bracket, which means I'd have to pay roughly $10,000 of income tax. But now that I've realized $100,000 of gains, I have to take $50,000 and add that to my income, which now puts my income at $100,000. Now, of course, as you make more as an income, the incremental tax brackets go up as well. So you pay more tax on that higher amount of income. But let's just say when I add that $50,000 to my income, it means I have to pay another $10,000 on that. So quick summary, I make $50,000 a year and I have to pay $10,000 of income tax. But I sold a bunch of investments and made $100,000 in gains. The capital gains tax says that I have to pay tax on half of that as income, so I add that, that's another $10,000 of income tax. So all in all, I owe $20,000 of income tax for that year. So here's where a really good financial advisor or tax accountant can help you save a lot in taxes. Remember, I realized $100,000 of gains, and I owe $10,000 of tax on that. If I take $25,000 of those gains and put that into my RRSP, that will nullify the $10,000 of taxes that I owe. So basically, all you have to do is take $25,000 and save it for your retirement in the future, and it's saving you $10,000 in taxes right now. So of course, I'm very glad I have enough room to put $25,000 of my gains into the RRSP. If I didn't have enough contribution room to put $25,000 in, I'd end up still paying taxes on my gains. So to sum that up, you want to utilize your RRSP contribution room when you're realizing capital gains or if you have a high income, which is why I personally don't max out my RRSP while I'm in a lower tax bracket. Unless, of course, I'm going to realize capital gains and sell some stocks in that particular year, which is like what I'm doing this year. Okay, now let's talk about the future when you're going to withdraw your funds from your TFSA or RRSP. As you withdraw the money from your TFSA, it's just like a cash savings account. There's no taxes at all. Let's just say, for example, you put $1,000 into your TFSA this year, and then in 30 years when you retire, that $1,000 has turned into $20,000. You still don't pay any taxes on that, and that $20,000 is just like cash in your savings account. Now, even though if I put $1,000 in my RRSP and it turns into $20,000 when I retire, there's no capital gains tax on those gains, but I still have to pay tax on that $20,000 when I withdraw it as if it were income. Now, it all depends on each individual's situation, but most people in their retirement fall within a lower tax bracket as they withdraw their RRSP. Now, let's say you have a good pension from your company and Social Security from the government, and you withdraw $30,000 a year from your RRSP. So that puts you in the tax bracket of a person making $50,000 of income at their job. So you're still going to be in a lower tax bracket than you were in your 50s if you were making $150,000 a year. Now really pay attention to this next part because this is the expert investor type stuff. If you invest in U.S. dividend-paying stocks of the huge blue-chip companies like Coca-Cola, Walmart, Home Depot, etc., then the USA, or the IRS, takes a piece of that dividend. They call it a withholding tax, and they take 15% of every dividend that those big companies give you. So let's say every month McDonald's pays a dividend of $1 for every stock that you own. The U.S. would withhold 15 cents of every dollar. Now here's where the big tip comes into play. Even if you hold these stocks within your TFSA, the U.S. still takes that 15%. But if you hold these stocks within your RRSP, the U.S. does not take that 15% withholding tax from your dividends. So let's say you hold 1,000 McDonald's stocks. They pay $1 a month to each stock, and 15% of that is $150. If you hold those stocks within your TFSA, that's $150 a month less that you'd be receiving from McDonald's dividends. But if you hold those stocks within your RRSP, you get 100% of those dividends, so it's $150 a month extra that you receive. So if you do want to hold those dividend-paying stocks, make sure you do so within your RRSP and not your TFSA. Now, I think that tip alone deserves a like and a subscribe, don't you? And also don't forget to share this video on your social medias or with your friends if you think they might be able to use that tip as well. One other very important tip to remember for your TFSA is that if you withdraw money, that contribution room isn't available again until the next calendar year. So let's say your washer and dryer break and you need to withdraw $3,000 from your TFSA to buy a new set. So you take that money out in June, and then in July you have a scratch and win lottery ticket and you win $3,000. So you think, oh, I'll put this right back into my TFSA since I took out $3,000 last month. The CRA would actually punish you 1% per month for everything that you're over your contribution room, which in this case would be $3,000. However, on January 1st of the next year, then that $3,000 is back open. So if you do take some money out of your TFSA in December, for example, to buy some Christmas presents, you only have to wait until the next month until you can put that money back in. As well, every January 1st, there's a new amount of contribution room. But this is on top of that new room because you removed it in the previous year. Your TFSAs started accruing room in 2009 and/or when you turned 18. Your TFSA started gaining contribution room in 2009 or since you've been 18. So if you were over 18 since 2009 and haven't used any of your contribution room in your TFSA yet, now that it's 2021, you've got $75,500 worth of contribution room. You can double check on your contribution room on the CRA website when you sign into your account. Also remember that these accounts are for investing and not for daily trading. You don't want to make too many trades within your tax-free savings accounts because the CRA will tax you on those gains as income. So there you go. Hopefully this video explained the difference between the two accounts and helped you understand which one might be best for you right now. Of course, if you have a lot of disposable income at any age, your best bet is to maximize both accounts. Remember to always keep planning for your future. Most people lack the ability to plan ahead, so the fact that you're watching this video in order to learn a little bit, you're already ahead of the game. Happy New Year, everyone, and as you're coming into tax season, remember that it's also a time that you can make some good decisions that will save you a lot of money in taxes. I hope that you all have a very prosperous 2021. Please make sure you've already hit the like button and subscribe to this channel, and remember to stay positive, not just in your minds, but in your bank accounts, because it's a matter of life and debt.